Hello, friends, and welcome to my YouTube channel Simply Stocks. And today I'm going to talk about Havells, a very renowned brand, but valuations look a bit stretched. So let's understand about the business. Let's get started. First of all, a disclaimer that this is not a stock recommendation. People taking any position to any share that I talk about should do that with their own due diligence and research, and I'm not in favor or against any company that I talk about. Before I talk about Havells, a small request to kindly support me on Patreon. Once you do that, it will help me grow the channel, help you also ask me questions and eke out answers in greater detail. Once you get the $10 membership, you'll have access to my portfolio, my watch list, and number of podcasts that I put up from time to time on market and company talk. And also, if you cannot pay on Patreon, you can join the YouTube membership on a monthly basis. Now, about the company, established in 1958, Havells provides a house improvement and consumer durable products. It is one of the renowned brands in this segment, and probably most of you would understand as to what the company is doing. It is a leader in water geysers, wires, and cables. Very good management, strong management, very good pedigree, and it entered into AC with the Lloyd deal, and they acquired Lloyd about a couple of years back, and they are selling ACs as well. But they also provide fans, LEDs, kitchen appliances, and water purifiers. So it's like a, you can say, a complete consumer durable product, white goods product company rather than just being wires and geysers company. Have operations in Africa, Asia, parts of Europe as well as Oceania. So European factor would play in here. There are some countries in Europe that they export to with the kind of volatility we are seeing there. Exposure into these regions might affect stock price in the short run. If you look at the financials, so sales went up by around 15% in the December quarter, but the profit reduced by 15% owing to lower margins, and margins really took a hit because expenses have, you can say, increased. And going forward in the next 2 quarters, I feel that expenses will be under pressure, and that's why the valuations look slightly stretched because the PE contraction may just take place. The PE is expanded, earnings is not coming through, but overall the business, the company is pretty good from a long-term point of view. ROE of around 20%, we have an operating profit margin of 12%, which has reduced over the last 2 3 quarters. So if you look at the performance of the stock performed well over the last 2 years. It has done extremely well from the lows. Numbers have been robust, except for the December quarter numbers have been good. But you need to look at margins, and margins have declined over the last couple of quarters. And going forward, it should remain under pressure with the kind of, you can say, inflation that we are looking at in India. I'm not talking of globally, in India itself. Profits have declined, as I said, on the back of margin pressure, and stock has gone up over 2x since 2020. So it can decline and consolidate, and this is exactly what is happening. That the stock has consolidated, declined, have gone completely out of picture. Very rare to see it in any trading calls. But these are levels to invest into from a 4 5 year point of view, not to trade into. But you will get opportunities to buy lower as well. As risk of environment set in, people might look to get into stocks which are more defensive in nature, like consumer staples, IT, or pharma. But why I believe it is a buy on decline is it is still one of the best in wires and cables, although Polycab is gaining a lot of market share from Havells, but Havells is also big on a number of products. So geysers, wires, cables, etc. They are doing extremely well, and future growth looks imminent with housing for all and infrastructure and real estate growth. I think Havells is set to do better over the next 4 5 years. It is a big consumption play. If you don't want to play the real estate, you can say, industry straight away by buying into real estate companies because of a lot of corporate, you can say, governance issue. You can play it through the wires, cables, and paints, you can say, industry, because that is a clear ancillary to the real estate segment. So Havells fits in the bill. Stock has run up, so wait for sharp falls, sharp declines, like the market is showing at the moment in the mid and small cap, and look to accumulate the stock at these levels. So I believe buy on major declines, and at current levels you can buy a few shares and then keep on buying on 5-7% declines. Keep track of numbers. If numbers really nosedive, then it's a different thing altogether. But overall, you can hold for the next 3 to 4 years, and you can make decent amount of money here and have less than 8%, 7% exposure into such stocks. So this was my video on Havells. Please like and subscribe my channel and hit the bell icon so you can get my video straight away when I post it. And kindly do support me through Patreon. Thanks a lot for watching.